Hi everyone, welcome back to the DDP Property channel. I'm Hannah and today we're tackling one of the most debated topics in property investment, negative gearing. Whether you're new to property investing or you have a few properties under your belt, you've probably heard about negative gearing. And you might be wondering, is it worth it? Negative gearing is a popular strategy in Australia, but it is not without controversy. Today, we're going to break down what it means, how it works, and whether it's the right move for you. So let's dive into the world of negative gearing and explore the pros and cons to help you make an informed decision. Okay, first things first. What is negative gearing? In simple terms, negative gearing occurs when the expenses of an investment property, things like loan interest, maintenance, and other costs, exceed the rental income. This creates a loss, which you can then claim as a tax deduction. Essentially, it allows investors to offset that loss against their income, which can reduce their overall tax liability. So for example, let's say you have a rental property that's generating $20,000 in rental income per year, but your costs, they're adding up to $25,000. So you're left with a $5,000 loss. This can be deducted from your taxable income, effectively lowering your tax bill. Now, let's go over some of the benefits. One of the main reasons investors are drawn to negative gearing is the tax relief. If you're in a high bracket income, being able to claim these losses can make a noticeable difference to your tax obligations. Another potential advantage is capital growth. Many investors who use negative gearing are betting on the property's value increasing over time. They're willing to accept short-term losses on rental income because they expect the property's long-term appreciation to eventually outweigh these losses. If the property market performs well, they could see significant capital gains when they eventually sell. So, for those with a long-term outlook, negative gearing can make sense, especially if the property is in a high-demand area with good potential for capital growth. The idea is that the property's future value increase could then make up for any short-term cash flow losses. And if you're in a strong capital growth market, this strategy could lead to substantial returns over time. However, it is important to remember that this is not guaranteed. Property markets fluctuate, and of course, there is always a risk that the property's value may not rise as expected. Okay, now let's talk about the flip side. Negative gearing is not without drawbacks, and it's definitely not a one-size-fits-all strategy. One of the main criticisms of negative gearing is that it relies on making a loss. You're essentially betting on future gains to justify those losses, which can be risky if property prices don't increase or if there's an economic downturn. Another thing to consider is cash flow. Negative gearing means that you're operating at a loss, so you'll need to have a steady income or savings to cover the shortfall. If you're relying heavily on tax deductions to make the numbers work, it could put a strain on your finances, especially if your circumstances change or if the rental market becomes more competitive. For some investors, this ongoing cost can be a significant burden. It's worth asking yourself if you're comfortable with sustaining a loss each month for the sake of potential future returns. Negative gearing can be a long-term play, and you need to be prepared to carry those costs for a while. Additionally, there's a possibility that tax policies around negative gearing could change. While it's currently allowed in Australia, some political movements have proposed limiting or even removing these deductions. If you're heavily reliant on negative gearing, a change in policy could impact your investment's financial viability. So, how do you decide if negative gearing is for you? Here are a few key points to consider. 1. Your financial stability. Negative gearing requires cash flow to support the loss each month. Make sure you have a stable income or at least a financial buffer to cover these ongoing costs. 2, your investment goals. If you're focused on long-term capital growth rather than short-term cash flow, negative gearing might align with your strategy. However, if you're looking for positive cash flow from day one, this may not be the best approach for you. And finally, risk tolerance. Property markets go up and down, and there is never a guarantee that your property will appreciate as expected. Think about your comfort level with market fluctuations and potential changes to tax policy. Let's compare this to positive gearing, where your rental income exceeds your expenses. Positive gearing provides immediate cash flow, but it also means you'll likely pay tax on your rental income. For some investors, this immediate return and reduced reliance on capital growth makes positive gearing a far more appealing option. It really does just come down to your personal and financial goals, and also your investment timeline. Positive gearing suits investors who prefer stability and those immediate returns, while negative gearing can work for those with a higher income and that long-term growth focus. At the end of the day, negative gearing is a tool. Like any investment strategy, it has its pros and cons, and it's important to understand both before diving in. Negative gearing can offer tax benefits and the potential for capital growth, but it does require patience, financial discipline, and a degree of risk tolerance. If you're considering negative gearing, speak to a financial advisor or a property expert who can assess your personal situation and help you to make an informed decision. At DDP Property, we specialize in helping investors just like you weigh the options and choose a strategy that aligns best with your goals. Thank you for joining me today. I hope this gave you a much clearer picture of the ins and outs of negative gearing. If you have found this video helpful, please give us a thumbs up and don't forget to subscribe to our channel for more property insights. Do drop a comment below if you've got any questions or if there's a particular topic you'd like us to cover next time. I'm Hannah with DDP Property, and I'll see you in the next video.